Many of you are joining us on YouTube, on LinkedIn, and our other various platforms. Very, very excited that Vishesh could spend time with us today. I know it's coming to the end of the year, and a lot of reporting requirements are figuring in. But the COVID vaccine just came in. There's a lot of optimism coming out, and we thought this would be a great time to take a pause and see where we are at with the economy. The Honorable Prime Minister has announced a large number of reforms in the past 3 to 5 months as well. We are beginning to see the contours of that, really to understand now what do these reforms mean and what will be the impact. So I think we're going to start off with a quick run through the numbers. Is that right, Vishesh?
I thought I'd just make some opening comments.
Perfect. Yeah, it's fantastic.
Take it from there. So if it's okay, I'll just make some opening comments, and then you can put the slides up. And I got somebody who's going to change the slides for me, Ritika. If there is still time. So however you want to play it.
Up to you, Vishesh. Let's start. And for those who are joining us on audio only mode, don't worry. Either you'll have the slides with you, and if you don't, we'll try to be as descriptive as possible, so you won't lose out.
Yeah, you would not need the slides, Aditya, if that's the worry. But I think with anything like this, let me first start with a disclaimer. I'm not feeling 100%, and because of that, or just technology. If this doesn't work, do jump in and tell me right away. Very happy to take a couple of steps back and restart, as is what happened last time we attempted to do this with the CII Northern region, when you quickly jumped on the opportunity and said, Vishesh, why don't we also do this for Delhi? So thank you, Aditya and CII for inviting me to speak to you on the state of the economy and the prospects. The second disclaimer I would use here is, I'm not an economist. I'm an accountant and a business leader, and therefore, if you were looking at an economist's perspective on the economy, this may not be the best place for you. I can only share with you from the business perspective what I'm seeing. I will share some statistics towards the end of this if there is still time.
So I am going to pause Vishesh's disclaimer there. The reason why we sort of wanted him to do this is that most economists, they just look at it from an armchair perspective. But Vishesh leads one of the top accounting firms in the country. They are involved at the back end doing everything from turnarounds to audits. They are deeply involved even in a lot of government matters. And I know Vishesh can't share a whole bunch of that because it is confidential, but he's the perfect guy who actually is seeing the numbers as they play out. And so that's why we have him here, and would love to get questions that sort of deep dive into that expertise as well. Sorry, Vishesh, please, back to you.
No, thank you, Aditya, for the generous introduction. So I think, let me just set the context at a high level. This pandemic is going to result in about a 5% contraction in the global economy in this current year, 2020. Everybody's expecting that contraction to reverse next year, just under 5% or entirely reverse next year. But I think that corresponds to somewhere between 12 to 14 trillion dollars as a whole in the global economy, right? A 12 to 14 trillion dollar hole. And just to contrast that for you, the Indian economy is just short of 3 trillion, right? To put that hole that the global economy has seen because of this pandemic. Again, to put that into context for you, if you were to compare that, the best reference point for comparison perhaps would be the global financial crisis of 2008. This impact of this pandemic is expected to be at least double of the impact on the global economy. The whole that crisis blew versus this crisis will blow by the time it's over, will be twice the size. The big difference further is that at that time, you would remember, China was booming. China single-handedly carried a lot of the economies that were dependent on commodities, being big commodity producers, the Australias of the world. That situation now is quite different. I think if you look at the numbers, already more than 150,000, 150,000 small and mid-sized businesses in the US have shut shop permanently. That's the number in the US. In India, out of our 6 or 7 million MSMEs, I would expect that number to be anywhere between 5 and 10 times that 150,000 number, 150,000 in the US. So, just as an opening statement, all I would say is vaccines. You talked about that. That is terrific news for everybody. But the echo effect of this pandemic is going to be long. Let's not forget that. And I'll come to why. The shadow this pandemic will cast on us will be a very long one, and not just 2021. But I think upfront, I also ought to perhaps recognize the Indian scenario. And when you look at it, I'd like to look at the long term. Since 2014, the 2 terms of Prime Minister Modi, we're now well into the second term. Of course, what the first term was characterized by was really significant legislation that has resulted in the position we are today, which is an entirely different business climate to what the climate was pre-2014. So if anybody believes the India of today and the India back in 2013 was the same country even to do business in, you ought to relook at things. Not just the insolvency and bankruptcy code you touched on Aditya, but RERA, GST, the simplification and implementation of the Companies Act, demonetization and the digitization. Collectively, so much new legislation that business, has had to deal with and adopt over that period. Of course, also what we've seen is the Prime Minister himself lead from the front on ease of doing business. And I understand the criticism around it only being Delhi and Bombay data, but that significant move from 134 to the low 60s, 70-point jump is a massive transformation. I can show you. I have a slide in the deck later on what comprises that move, but that's a massive transformation. Indeed, is given a playbook for competitive federalism, right? How do you get states to adopt that same priority and compete with each other on how they're doing or ease of doing business? Since then, in this Modi 2.0, the current government of Prime Minister Modi, again, very significant moves. If you look at the corporate tax reduction, for new units as well as overall corporate tax reduction is a significant step that wasn't expected outside a budget, right? If you look at the new education policy that's been announced, certainly the new essential commodities Amendment Act. I know there is not full buy-in on that, but the farm changes, the ending government monopoly across sectors, what's happening on privatization, the labor codes, 29 labor codes being consolidated into 4, the impetus to manufacturing, and if you look at it, everyone was suspecting, what does Make in India really stand for? Again, this crisis has perhaps provided that opportunity to put some substance behind the intention of Make in India through Atmanirbhar Bharat, through the production-linked incentive schemes and the like. So, the India of today is definitely a different India to what you were used to, rightly so in many, many ways, and is set up for, I would, take a punt on that, set up for, exponentially different performance than what we've seen in the last 4 or 5 years, as some of these changes have come in. So changing track and going back to COVID for a minute, really, if you look at COVID, in the living memory of everybody who's alive today, it is the first real global crisis, right, which has impacted almost every country around the world. If you look at most of the other crises, it was still restricted to a certain number of markets, may have hit other markets in some ways. What it provides is the opportunity, of course, to learn from the positives. How do you replicate the development of vaccines at this pace, 6, 7, 8 months to have multiple vaccines will be phenomenal, but also a wake-up call for the future. I think, how do we ensure that nation states can learn from the mistakes made, but also learn from that these sort of crises will play up again in the future, right? Whether it is around climate change or the natural disasters that climate change, all of us hope will not happen, but will happen. But how do nation states come together and play their part? How do we as a nation state learn from the tragedies we've seen and make a different investment in healthcare versus what we've been currently making, the 1.3% of our GDP. Of course, as far as the Indian response is concerned, the Indian response to the pandemic, there are clearly two views. The first one on the quantum of the response, was fiscal deficit targeting, country sovereign rating, being top of mind. Was that the right response? And therefore, in quantum, was it quite enough, or could more have been done? Certainly, that response. Apologies. Certainly that response could have been, more than what it was if the intention was to revive demand. But at the same time, it was extremely well sequenced. Very few people will disagree that the priority in which the government acted was extremely well sequenced. The lockdown, of course, was the most severe in the world, which saw the most severe quarterly impact in that 20% plus impact on our quarter's GDP. Really, that 1% of GDP, so more than 2.5 lakh crores per day, was the impact of each day of lockdown. Right, 1% of GDP, 2.5 lakh crores for each day of lockdown is what we suffered. Of course, unique in the world. People will say that no other place shut down manufacturing like we did. Was that right or wrong? We have to remember, the state of our healthcare system is different to those other countries that you make comparisons with.
I'd like to add also two points. You and I have been meeting every couple of months in the CII stuff, and we've been taking looking at these polls and bringing all this data. But even before COVID, India was sort of going down this entire slowdown path.
Yes.
If you look at Jan, Feb, and all, everybody was talking about the Indian slowdown, the need for reform, the recovery, and then, bam, we hit into COVID. And the second part of the COVID response was pretty much everybody was told, take on more debt. Other countries had cash injections into businesses. They had grants that were given. Countries like the UK, Malta, and all picked up the entire payroll bill of all the companies. And India was very much said, guys, take on more debt. Now, here is a bunch of loans. We'll give you more credit access. And as you're going through this, would love to get that perspective also, because my brain is still stuck on that figure which you started out on, right? That the 10x number of SMEs which will probably shut down, 1 million, 1.5 million. And it's going to take a while for them to sort of come in. And this was on top of already a slowdown happening. And I think the context is important for our viewers and our listeners. It's not like we were the US, which was in an absolute boom, right? Jan, Feb, jobless ratings absolutely low, almost achieving full employment, and then COVID hits. India was stressed, and then COVID hit.
Yes. No, I think that's a very good point. I think absolutely, our economic growth, if you look at the last quarter of FY20, which is the March quarter, we were already down to sub 4% growth. For the year to March 20, we were already 4.5, 4.6 odd percent growth is what we had in that year. So we were significantly off the 8% kind of growth of 2010, or even the 6.5, 7% that we would consider reasonable. Or expected in the post-GST era, right? Everybody expected GST to add 1.5, 2% to our to our GDP growth, right? Where is that 1.5–2%? People would ask. So absolutely, I think the thing we have to remember is, we will have to grow at least 8% year on year if we want to get to our 5 trillion economy, right? 7–8% is what we need to grow to get to a 5 trillion economy, and that is by 2030. That is not by 2025 as the government's targeting. That's what we get to if we grow at 7–8%. So I think coming to your other question on the number of MSMEs that have shut down in India permanently, many of them in food and beverage and aviation, hospitality, tourism, and just for across board, the big challenge, not just in MSMEs, even through the big companies, is unemployment. Right, more than 5 million people have gone out of the labor system permanently because of a decline in wages and a decline in opportunity. 5 million people aren't coming back into the system. So I think dealing with that unemployment will be a significant challenge up ahead. And the big positive from COVID is going to be digitization. But that digitization is only going to compound that unemployment trend that everybody is very familiar with, right? How do we solve that problem? I don't have an answer, but that industry has to sit together and find an answer to that problem. And I think eventually social security, how center and state work together to provide adequate social security, like we've done with our amazing healthcare scheme, is an answer where you have to take care of the bottom of the pyramid, like we did with our first response. From this pandemic. I think the other risk just there, when I touched on unemployment, let me also touch on inflation. Nikhil Soni asked me the same question at CII Northern Region, you remember. What's going to be the impact on inflation with all this liquidity coming in India as well as in other markets? Does the world economy have the risk of a significant inflation spike, of us going back to the sort of 80s, when even the developed Western market economies had inflation? And of course, the Economist covered the entire significant cover story on that in the last issue, and I recommend you look at that if you want the detailed statistics on that. But I'd say the difference, if you look at it, to the last crisis, again the global financial crisis, what I go back to, that financial crisis was one about a credit crunch, and therefore whatever stimulus was put into the economy in Western markets and other markets, that went in to basically fill up the gap from that credit crunch. The situation now is quite different. This is about the stimulus that has gone in has taken money supply in the system back to the 1980s level already, right? And therefore the risks for sustained inflation in the medium term are high. At the same time, there is widespread appreciation amongst the economists that the link between money supply, when you lower interest rates, money supply goes up, and prices is not one for one as was expected in the past. It's much weaker because it's driven by two other factors, and those two factors mainly are around, one, the expectations of consumers on increases in prices in the future. So if consumers are expecting prices will increase rapidly, they would buy, right? Versus wait for prices to increase and then have to buy. The second is the strength of the labor markets, employment. If people don't have a job, they aren't going to buy. And therefore, I think, while some of the risks are there because of where money supply is, I don't see, us seeing runaway inflation in India or elsewhere into the future. In India, we've seen in the month of October and September inflation in the 7%, I think 7.2 and 7.6 in October and September.
And so
in November is 6.8 odd percent on inflation. So we come back to that.
The inflation numbers. I mean, so here's an alternative take, right? The RBI refused to cut rates, saying they're worried about inflation. And by the way, everyone, that's one of the big reasons why we are talking about inflation. It's not an academic interest, but if the RBI doesn't cut rates, loans are still expensive, and India is one of the still I think right now, perhaps in all so-called developed or developing countries, it's still the highest rates of lending and borrowing in the world. I mean, you could pretty much get money for free in almost all OECD top countries. India is still very much, in the, I mean,
Yeah.
it's stuck in the double digits, 11, 12, 13, 15%, right? When it finally hits a business person on the ground, or if someone's taking a personal loan. And for me, one of the things which I keep pushing, and this is something that we see in all businesses, is that fundamental economic assumption, right? That RBI or the government does quantitative easing, helicopter money in, pushing it in, or they bring down rates. And there's this beautiful levering system where the rate goes to the banks give it to the companies give it to consumers, and everything starts to rise and you have inflation. But in India, that never happens, right? Because everything is broken. So even if the RBI is bringing down its rates, it could be years before it actually hits the ground, right? So unlike more efficient economies, let's be polite about it, where a change at the rate at the top or this, you suddenly see dramatic impact within 2 to 3 months on the ground. India has always had that large policy lag. And so why is still this mental model of inflation still haunting industry today?
Well, I think you said two or three things. So first of all, the prime lending rate of the top five banks, public sector banks, is closer to 9%, 8.8%.
But prime.
But I think between the banks and the consumer, there's often also an NBFC, right, where the rates may be closer to the double digit that you talked about. You talked about the rate transmission and the lag between the transmission from cutting the repo rate to what gets transmitted to the
down to inflation, right? Because the repo rate cuts, then the banks have to announce, the bank transmit, which banks are going to renegotiate loans. It's a long time.
Yeah, so I can't disagree with that part. I think you talked about the inflation and inflation targeting, and that I think the MPC of the RBI, which actually looks at taking that decision. Now the decision is not taken by the governor; it's taken by the Monetary Policy Committee, which is a selection of individuals who sit on that. The guidance there is that 4% targeting, inflation targeting of 4% plus minus 2%, right? So we work on a 2% to 6% band on retail inflation, CPI. Yes, we are slightly higher than that, and therefore you can expect a prolonged pause on any further rate cuts from this 400.
How do you degrow or deconstruct economy by 5% and 10% and still get inflation?
Yeah, so I think again, as I said, rates have come down 115 basis points. I think the issue actually is more complex than just rates.
Absolutely.
Has to take off. Capacities are still at 70% in industry overall. Perhaps auto is an outlier, but beyond auto, I don't know too many others who are seeing the demand or the fall in inventories. That's going to see new investments in other manufacturing. So one's hoping that some of these steps on identifying the priority sectors, going after the China plus one opportunity that has emerged from the relocating supply chains, the production linked incentives that have been announced by the government. People will make use of that and start investing. But I think the challenge there, I said, is beyond just rates. The challenge really is demand revival. That's what we will need in order for the economic growth to go back to the to even 6% from where we were pre-pandemic. If we were to take the pandemic out, of course, we need to get up to 8% to live up to our potential as a country. So I think let me just finish my comments, and I can go to the slides and take you through some data, because people will be crying from an accountant, how much can we hear? Please also show us some numbers, and I'll show you the numbers. I think really, in summarizing, getting the vaccine in this 7-8 month period is the biggest upside we've seen in this pandemic. I heard from Mr. Kotak for the first time. I don't know who the author is, but I heard the terms geography is history. I think that's the second biggest upside from this pandemic. Geography is history, right? Basically, whilst we see an impact on commercial real estate in the short to medium term, the real opportunity for India lies in trying to move the $200,000, $300,000 jobs to India in the next 3 to 5 years when you come to services. I talked a lot about manufacturing, but if you look at services, not just the $50,000 jobs, but that's what we were earlier replacing in India. That's what will also create further jobs. The moment you move those managerial and more complex jobs to India in the future, as people realize you don't, if you have people, you don't need to have people in the same office, in the same city, even in the same country. That trend is expediting. I think this new world order is a huge positive for India. The dependence on China, and therefore big companies clearly looking at the China plus one strategy, and we're seeing investments there, right? Samsung's big announcement, everybody would have seen last week. I'll show you the FDI data, which will revalidate that for everyone. Of course, everybody knows 20 billion of that 30 billion FDI we've got since April has gone into one business house. I think we need to, the world has become more aware of how to deal with China. China plays with its own rules and doesn't play with the rules of the game. I think that is a positive for India. And really from this pandemic, we have to take, sit down collectively between the country and the states and between countries around the world and build that playbook, learn from that, vaccine development, still, the supply of drugs around the world, and build that playbook on how we deal with future calamities. And of course, the single biggest, I'll finish with that, the single biggest transformation is that digital transformation, Aditya. We've seen that transformation personally, right? Everywhere. If you look at payments, if you look at, pretty much using a card everywhere now versus, and it's not just, in paying for things, it is literally signing into things, paper money's, disappearing. But we're also seeing that in the business sector, how even mid-sized companies are now actively considering, creating virtual shared service centers, with, then going into digitization of processes and adopting, things like robotic process automation, things like just basic, not just scanning documents, but basic OCR, optical character recognition on their customer invoices and supplier invoices, so that those things can be automated, right? You can just read those go hit an Excel sheet and eventually hit your financial systems and record things. And humans, sort of human then goes in and glances at it. Of course, the downside in all that is it is going to replace people. And this is going to be, middle management is where it's going to impact the most in the next 2 to 3 years, and therefore further extend that challenge of unemployment. So should we just quickly jump onto some of the slides?
Yeah, no, great, fantastic. I think let's get those numbers, and I think that at least give us a little bit more context.
Okay.
I think Ritika is showing the screen. Excellent.
Yeah, so this is basically the IMF's forecast for the world GDP growth. So the global GDP growth, the IMF has revised that global GDP growth forecast. It was projecting that 5% contraction that I talked about, 4.9% in 2020. It's now revised that to 4.4% in FY20, and next year, as I said, it's expecting that we will recover. So therefore, next year, the recovery, if you see in that teal color on top, is 5.2% in 2021. I think the important thing there is that is why I call this the lost 2 years, right? Whatever recovers next year will take us back to the position, and that's no different even with India. Even though the RBI is now forecasting the total contraction in FY21 to be only 7.5%. IMF's October projection was this minus 10.3%. It's going to be somewhere in that range, and it doesn't really matter if it's minus 7.5 or minus 10. At least in my view, I think what matters is next year the projected change from that is plus 8. Right? We therefore go back in March 2022 to the level we were at in March 2020, right? That is the size of economy we will have back then, right? The same 2.7 trillion economy is what we will have. And therefore, obviously I call this the last 2 years. You can see how, the IMF, which releases its forecast every 3 odd months, how consistently the forecast for 2020 and 21 has changed for India, from 1.9% growth in April 2020 when they forecast to 4.5% minus in June to 10.3% in October. When they come up with the next forecast in Jan, I would expect somewhere around 8.5% is where IMF will probably say we will contract in 2020. Next slide, please.
Can we just go back to that one? Because, for those who don't have access to the slides, there are two very interesting figures that I wanted to hear. One, of course, is so what Vishesh was talking about was IMF does a quarterly update on what they think how will the year end up as. And, they started off in October 2019 saying it'll be 7%. Then in Jan 2020, they said 5.8. In April 2020, it went to 1.9. By June, it was minus 4.5. And by October, they were saying minus 10.3. If you look at there's another figure there. China, for example, is supposed to go up by 1.9. And I think that shows you a huge difference on how China is, at least from a perception perspective, has been able to bounce back during this pandemic. India minus 10.3. You have emerging and development markets in Asia minus 1.7. Euro area at minus 8.3. US at minus 4.3. World at minus 4.4. With India at minus 10.3, I think the IMF is really, really pessimistic about that outlook. It's a huge difference, right?
Yeah, I think it's the same thing. What I talked about, the most stringent lockdown anywhere in the world, and therefore the most, the sort of biggest impact. I think we're competing with the UK for that, impact in that June quarter, right? The April to June quarter. I think India and the UK were the two countries that had that, 20% dip in quarterly GDP for somewhat different reasons, but. I don't think you can compare that with, say, Sweden, which hardly had any lockdown, right? They chose a different, different approach. Of course, they paid for that with the number of deaths. They didn't do any lockdown, and Sweden had 7,000 deaths compared to their neighbors, which had some hundreds, right? Norway and Finland and others had in 200-300 deaths compared to Sweden. So I'm not doubting that we needed to do a lockdown. That lockdown needed to be harsh, and as I said,
we're seeing the impact. We're seeing the impact.
1% of GDP per day. You can see, we had, the sort of lockdown compared to where we would have been. Okay, let's go to the next slide, please. I've got 13 or 14 slides, so you can paste this as you like. We're now on slide number 2, and I thought, what the point you were making earlier, when we were speaking, this slide basically shows India's 10-year GDP growth, from that high of 8.5% in 2010 to, the 4.8 odd percent in March 20, right, for FY20. So we were already on that slowing curve, as you can see on the slides. I know the slides are not in front of everyone, but we were at, the mid 8% in 2010. We were at the mid 8% in 2015-16. That's March 16. And since then, it's been a rapid slide down towards the mid 4%, right? That's really the outlook. And of course, if you please go to the next slide, Ritika. I think if you look at the quarterly change in GDP in a shorter period, that was 10 years. This is just quarter on quarter what's been the change. This again shows that slowdown you were referring to, Aditya. 6.2% in quarter 2 of 2018, right? FY18, quarter 2. So that is 2017, the July to September quarter, right? July to September of 2017, we were at 6.2, 5.6 the next quarter, 5.7, 5.2, 4.4, 4.1, 3.1 in the quarter 4 of 2019, right? Quarter 4 of 2019, of course, we had one week, 10 days of pandemic impact. Sorry, this should have said FY20. My apologies. So quarter 4 of FY20 was 3.1%, right? Which is the Jan to March quarter. And then if you look at FY21, please read that as FY21, the 23.9% in that April to June quarter because of the lockdown, the 20+% I talked about, and then quarter 2, 7.5% decline still. So recovering economy, but not quite. Of course, what you can see there is how manufacturing has recovered, right? You can see on the slide, manufacturing saw that massive contraction in quarter 1 of FY21, right? Of this massive 40% contraction because of that lockdown. Services, financial services, and other services only saw between 5 to 10% contraction. Manufacturing has recovered from that minus 40% to a positive territory, and I'll just come to IIP and show you that data. But services, if you look at it, is yet to recover. Of course, as we know, hospitality, tourism, aviation, and all that will have a longer drag, to sort of to recover. And therefore, our economy will also have a longer drag because there's more than 60% of the economy, as we know, comes from services. Agriculture has held steady. Good monsoon helped, and that was in some ways the saving grace. But only under 20% comes from agriculture. Please carry on, Ritika. The IIP data, again, industrial production had this unexpected rise in the month of September. Everybody was expecting a decline. We had, of course, declines in each month before that, significant declines, from 57% decline in April to only a 7.5% decline in August. But you can see in the month of September, we saw an increase in the index of industrial production. The other good one was, good news was this 8-year high that our PMI, both composite PMI as well as manufacturing and services PMI within that, where it reached in the month of October. PMI is basically the Purchase Managers Index, and I'm just saying this so that everybody's aware. Basically, more than 50 means an expansion, less than 50 means a contraction in PMI. Basically, the people ask purchasing managers in companies, are you going to place orders or not, right? In manufacturing companies and service companies, and that's how this is measured. And if you see the months of September, October, November, you can see an expansion in the composite PMI of 54, 58, and 56, right? So a little bit of festive demand. You can see in the month, in the orders placed in October for the festive season in November, but overall you can definitely see a recovery in orders, and that plays out both in manufacturing and services when you drill down and look at the PMI for those two separately versus at the composite level. I'll very briefly touch on trade, and really the news there on trade is imports have continued to fall at a rate which is more than exports because of the lack of demand in the economy, which has led to an overall trade surplus, merchandise trade deficit, but overall trade surplus in that April to November period that we can see. One expects some of this to reverse because imports will again rise in the future as the demand picks up in the economy and as we see that revival. But you can see obviously the impact on exports and imports in the
Vishesh, so just so that we can get all of our listeners in, so we are saying April to November on merchandise, the exports were about 173.66 billion, imports were 215.67, still a trade deficit. Services, of course, we exported more, 130 billion, and imported 74.98 billion. So we have a surplus. So an overall surplus. But I imagine that a lot of the imports you were talking about in merchandise is basically oil, right? That's one of the biggest drivers.
Yeah, basically non-oil and non-gold imports, which basically show the strength of domestic demand, that shrank 1.67% in the month of November, right? When you compare to November the year before. So if you strip out oil, you strip out gold, which really shows you the strength of domestic demand, even that was 1.67% lower. If you were to look at just November data,
which to me is a fantastic number, right? Because everybody's been buying gold. I would presume as a safety thing during COVID, because of just they're worried about the financial markets. Although the stock market has been going up, and oil after the initial lockdown would slowly start coming back as we have manufacturing, transport, everything started to open up. But the real picture is an actual contraction of our domestic consumption.
So yeah, let's move forward, and you'll get a better picture of some of this. Could we go to the next slide, please? So I talked about the impact on inflation, and retail inflation. If you see on the next slide, the RBI has that reference range of 2 to 6%. I talked about. Luckily in November it eased to 6.93%, as you can see on the slide. After the months before that, 2 straight months it was above 7%. It's obviously beyond the target, which basically means if you could get the other graph also, the central bank will therefore have to hold rates. We expect that to be a long pause. Those rates I talked about earlier, you can see already slashed from 5.15% in January 20 to 4%. So 515 basis points to 400 basis points, 115 basis point cut in the repo rate that we already saw. I think basically it's likely to remain. Inflation is likely to remain elevated as manufacturers and service providers are expected to jack up prices as they see a pickup in consumer demand. You can see the consumer spending graph on the charts. Of course, as expected, consumer spending came down drastically in the quarter two, and so basically you can see the July number and October numbers on the slide. I think the consumer spending in India is forecast to have contracted by 12.6% in 2020, and it's expected to expand by only 6.6% in 2021. Right, a contraction of 12.6% in consumer spending in 2020, and an expansion by 6.6% in 2021. In nominal terms, if you look at it, household spending will increase by only, and this is in nominal terms, by only 1.2%. Than what it was pre-pandemic last year. Right, so therefore households aren't spending anything more than what was being spent earlier. Next slide, please. I think if we look at the credit, and I talked about the lack of growth in credit, and this is the non-food credit growth, which has now slipped to under 6% in August and September, and closer to 5% during the period thereafter, and that compares to more than 8% is where credit growth was earlier. And I think basically that is driven by a contraction to large industries. It is not Aditya, that medium-sized industries are seeing a decline in credit to them. Large industries have seen a contraction of 1.7% in October compared to a growth if you compare with October last year. Medium-sized industries have seen an expansion, a double-digit expansion actually, of 16.7% in October in credit growth compared to earlier. And again, if you look at personal loans have declined in that period. Personal loan growth decelerated to 9.3% as compared to 17.2% in October of last year. I'm comparing October 2020 to October 2019. And the exception there again is auto personal loans for buying vehicles, which actually saw an expansion, which all of us read about regularly, the increase in vehicles. Aditya, if you could just bring the rest of the graphs on there, and you can see the sale of passenger vehicles increasing on the graphs in front of you from what was of course a contraction in the months immediately post the lockdown to an expansion, of course a slowing expansion thereafter, but definitely that is the message from all the auto sector players.
Vishesh, just pause here, right? And again, so people who can't see the graph, what we are seeing is total domestic sales of passenger vehicles increasing. But I'm seeing October 19 to Feb 2020, minus 12.2, 12.8, minus 13.1, minus 9.9, 11. Then we tanked during COVID, minus 55, 100, 89, minus 64, minus 16.1. And now we're seeing recoveries 9.5, 23.8, 10.8. What do you make of this this period between October and Feb when we already had this decline happening?
Yeah, so the auto sector, we talked about the declining economy. Everybody knows the auto sector was in a steep decline way before the rest of the economy itself. So therefore, the auto sector is probably going back. Where people ask the question, not when will we go back to the previous year numbers. It's actually the 2 years ago numbers. And it's basically the base effect.
I think it's also very important context, right? Because one is that, oh, it's so bad that they haven't recovered. But if you're at 23.9, 10.8, even if it's just pent up demand, the fact that we're still seeing upswings is fantastic.
Yes, but those upswings are still getting the industry back to
normal.
To levels 2 years ago. That's what people are hoping for. At the same time, from a corporate's perspective, most corporates have used the pandemic to reduce staff, to reduce overheads, to reduce what they pay for those things, even on a continuing basis. So therefore, corporate balance sheets will look healthier. Corporate P&Ls will show better performance in the next couple of years, which is what what you're seeing in the markets. And I'll come to the markets shortly. So Ritika, if you could please go to the next slide. And before we come to the markets, obviously people want to know what's happening with the rupee, and the rupee's really gained in value in the months following the lockdown. Main reasons, weak American currency, largely because of that political uncertainty in that country. Also, FPIs pumping in money, recognizing that economic opportunity differential that our economy provides. Once corporates make use of the opportunity provided by the pandemic to clean up their cost structures, they can obviously expect to see that performance upside going forward. Oil prices, direct impact on our currency, just because of how much of our oil, 80+% we import. Oil prices have recovered. Obviously, the main reason for that is hopes of this vaccine, and therefore that demand revival. Both Brent and that WTI West Texas Intermediate, which in an unprecedented manner went into a negative territory. You could make money by buying oil back towards the pandemic because of storage capacity issues. That's rallied now for 6 consecutive weeks, the longest stretch of that rally since June. Crude oil is also up, and of course, again, the reason for that is that demand recovery, as well as continuation of the OPEC plus countries cutting production. Oil price, in my opinion, and whatever I've seen so far, you can expect it to remain volatile in the near term. And therefore, you can also expect, in some ways, volatility and actually an increase in the retail price of diesel and petrol in our country. Next slide, please. I think if we unemployment, I touched on this a fair bit earlier. and therefore I'm not going to go into the numbers now. But basically, if you look at the latest month data, a further 3.5 million people, workers, are now out of the workforce. In the month of November, around 5 million I talked about earlier are potentially out of the workforce permanently, and therefore the sustained loss of jobs and the falling wage rates are the main drivers for that, according to CMIE that does this research. With a overall 22.5 million people who are inactive and unemployed in the month of November, almost twice that previously. So I don't want to go into those numbers further, but you can see the unemployment graph rise, and I can't see this change dramatically because I can't see industry or services in the near term hiring people. They will make replacement hires, but the rest will be filled with automation and those sort of things. And therefore, it's only new capacity coming in that will create new jobs. Next slide, please. And I think we are now nearing the end, and I think basically the FDI graph I talked about. Of course, if you look at the FDI, in the post-pandemic months, in the month of June, April, May, June, FDI went to a trickle. But if you look at the post-pandemic months, August, September, significant FDI, $17.8 billion of FDI only in the month of August. You can see that huge skyscraper, and that huge skyscraper is coming from the likes of Facebook and the multiple funds. As I talked about, the 20 billion that's gone into one platform, the Reliance digital and retail sort of platform in the country. Overall, an increase of 15% in FDI if we look at the 6 months from April to September 2020 to $30 billion. I remember some years ago when our FDI used to be 3 billion, 5 billion, and we used to look at the China numbers of 40 billion, 50 billion. We used to wonder if it'll ever go back, and I think we are now in that period. So
here's one thing which we've all been sort of waiting for, right? You had trillions and trillions of dollars being poured into quantitative easing. I mean, from what I remember, I mean, the US has put more stimulus than the entire financial crisis combined, plus all the war spending, etc., for 10 years, and they just pushed it out in one go, right? It was an absolute flood of money in the US, flood of money in the UK, flood of money all across Europe, Japan, everywhere else. Apart from, of course, 1 or 2 mega deals that India saw, how much of this money is coming to India? Are we seeing that sort of that? Okay, and it was string-free money for the most part, right? So at some point, it has to go find something, and India has always positioned itself as hey, you want more than 3 to 5%, you have to look at you have to look at India, and you have to look at emerging markets. Are we seeing that money come in yet?
Yeah, so we're seeing money both in the FPIs, into the markets. That's why, the stock markets, I think that's the next slide, are where they are. Aditya, if you could just go to the next slide. And we're seeing, of course, the foreign direct investment coming to India, $30 billion, which is what is, giving that strength to our currency. As we're seeing, this is basically, you can see on the slide, from the pandemic lows, the steep curve that our stock markets have taken, not just to pre-pandemic levels, but lifetime highs. Both the major stock exchange indices, the Sensex and the Nifty, Sensex 30, Nifty 50, at well above pre-pandemic highs, and that's when domestic market investors have taken money out of the markets, right? At least retail investors. Next slide, please.
So would a theory, and this is just a theory, be that look, we have all this money sort of pouring in around the world. Some portion of that money came into India, and obviously they are waiting to, let's say, deploy it into whatever PE, VC funds. But meanwhile, they seem to have parked it in the stock market, and that's why we are seeing this crazy boost.
I mean, it's difficult to make that corollary. At least, I am not able to, make that direct, relationship that money that's coming into India is because of the excess liquidity, that is pumped into the Western systems. I think it's really, money chases opportunity, and if you look at the long-term prospects of the economy, we've only talked about prospects of next year. The last 2 years take us back to where we were, but after that, we're still seeing a change from March 22 till March 2030, even on a worst case forecast, a doubling, right? From the 2.7 trillion to 5 trillion. Where else in the world are you going to see a doubling of your of your money? The euro area isn't delivering that. Japan isn't delivering that. The UK isn't delivering that. The US certainly isn't delivering that. So where else would you see that sort of return? I think and we will get to that 5 trillion, and that's presuming the currency remains in the same place, right? If the rupee goes to 38 to the dollar, we get to 10 trillion, which is where the government wanted to be, right? So
absolutely. I think that's a point well made. I think no one's arguing that India won't get to that 5 trillion, and right now it's just when.
The next slide. If you go to the next slide, I'll show you why, Aditya. I think we'll be running out of time. So again, I like looking at things over a long-term period versus short-term data. Particularly in a post-pandemic world, short-term data isn't that relevant. This is really, if you see this chart in front of you, this is the ease of doing business rankings in India and how those rankings have changed overall from 134 in 2015 to 63 in 2020. I touched on this earlier, and it's color-coded to show you that transition from the high numbers, right? The 134, 150s in the world towards the greens, the yellows and then the greens. Can you see that transition in that period? That foundation that is being laid. And if you see within that, these are the 10 elements that go into the World Bank's ease of doing business ranking. The overall 134, which last year was 63 in the world, and the government expects that to be in the top 30 in the next couple of years. I don't think anyone had the confidence that we could even aspire for top 30 in 2014, 2015, right? But now it looks realistic to be in the top 30 in ease of doing business. So therefore, let's not take for granted or not appreciate the amount of pain that a lot of people have suffered to make this transition. That transition on getting electricity. If you look at it, from 137 in the world to 22 in the world, right? That 175.
And those are some big jumps there. Yeah.
Target by 2022, right? Massive.
Even trade. I mean, going from things got worse. We actually lost down to 146, and then dramatic jump to 68, right?
Yeah. Which one are you talking about? Trading across borders.
Borders, exactly. Right? Huge jump.
Yeah, and that's just the beginning. I think we still have challenges. We've got to fix our logistics, but obviously, GST coming in has reduced, the time it takes to hit the borders or to, move goods. So that's why you've seen that move from 126 on trading across borders in 2015 to 68. You've seen that move in dealing with construction permits, in the post-RERA era. In the post-RERA era. Dealing with construction permits, 184 in the world in 2015 to 27 in the world in 2020, right? Dealing with construction permits. So already in the top 30. If you look at, other aspects where we were pretty good anyway, getting credit, protecting minority investors, we were, already very high. And I wouldn't, make too much of that downward move, from 7 to 13, 7 in protecting minority investors to 13 in 2020. But I think big work remains to be done in enforcing contracts. I've always maintained if India has to transform, we've got to fix our legal system, reduce the time it takes to resolve disputes in our country, and we're seeing that in terms of arbitrations that are fleeing towards Singapore and other arbitration centers, but also the government's recognized that and is trying to create better dispute resolution processes within within the country. Some of the big business houses, as you know, have gotten together to create a dispute resolution facility also. But I think that enforcing contracts is what is the single biggest opportunity that will see a transformation of India. 186 in 2015, but still 163 in 2020. Of course, resolving insolvency seen that massive change. 137 in 2015 to 52. I think we'll see a further change on that as we learn from IBC and further simplify and stick to that 180-day timeline under IBC. So that's really the last slide I have with data.
I think this is a great slide to end on, and just for all of all of our viewers, we are not going to get a 2021 ranking. The World Bank has unfortunately shelved rankings for a year while it sorts through some internal issues on this. But these are big things, and this is, by the way, not included. And this is a great time to transition. We have still about, I think, 15-20 minutes left on time. These do not include the reforms that have happened in the last 3 to 4 months, correct?
Absolutely. This is last year's ranking, and you're right. Yeah, I was speaking to Junaid Ahmed, the country director of the World Bank. They are going to take a pause to just relook at the methodology and stuff, but they're very committed to this survey. And again, very pleased at what they've seen. How India has adopted the survey, and actually not just adopted as a country. Overall vision and target of being in the top 50, then in the top 30, but pass that on to states, because so much of doing business in India is about doing business in states, right? It's not just the same.
And this ranking is basically Mumbai, Maharashtra. So obviously a pinch of salt there, but India is a vast country. There are states who are doing much better. So so the World Bank uses a simulated business in Bombay, Mumbai, to come up with these figures. But like I said, there are states who are actually much better at this.
Yeah, it is both Mumbai and Delhi, Aditya. But yeah, India is bigger than just Mumbai and Delhi. This ranking is restricted to their methodology, in those two places. So the city of Mumbai and the city of Delhi, if you were doing business in, not necessarily all of India.
But not Tamil Nadu or Gujarat or Telangana, right?
Yeah, I would not get fixated on the individual accuracy of a particular number. I think that's why there's those colors. Unfortunately, people who are listening in can't see the colors. But if I can just paint a picture, you can just imagine a sort of sunrise, bright orange reds on in 2015 is where we were, and now we are at sort of absolute near greens towards 2020 in terms of the trend, how things have evolved. Last couple of slides. Do we still have time?
We still have time. We have about 15-20 minutes, and I'm glad we are transitioning to these, because the number one question that has come up, we've had 4 or 5 questions so far, have been what are the big reforms that you think are going to really move the needle?
Yeah, so this is obviously the single biggest one of those that is coming up in the future. I talked about some of the reforms in the past. Let's not forget, GST still has to play out, IBC still has to play out, RERA still has to play out. And I touched on all those, but going forward, some of the things, one of the big ones is how these 29, labor laws are coming in. I've got my colleague Vikas Vasal and Sachin Sharma also, who can, add more on these aspects. But really, Vikas, before you come in, just 29 labor laws in the country getting compressed into 4 is just transformational. Yes, there will be some challenges around social security. For example, now basic salary needs to be at least 50%. That will have an impact on gratuity. That will have an impact on reducing the take-home pay available to employees. It's yet to be legislated. Previous slide, please. But I really feel this will be a game-changing reform going forward.
So I think Vishesh, the big question on this is, how game-changing. I was actually in a meeting with the Minister of State this morning with one of the chambers, and we were talking about some of the side effects. One big concern I think industry always has. One, we are all begging for reform, and the fact that the government has taken the leadership in even addressing this is phenomenal. I mean, to even attempt to do this is a huge political jump here. But the big worry is that, so was GST, right? And the implementation left a lot to be desired. It took a couple of years to even settle down, and we are still, dealing with the side effects of a law that had to be implemented imperfectly because of, India being India. As obviously they are still changing this as it goes through, but do you see, is there a prediction of impact? Are we seeing hiring will go up by X? Do you see, a growth impact per GDP by Y? Or it's still very much going to be left until the implementation happens?
Well, again, the same thing. I've never understood how people make these predictions of, GST is going to increase the GDP by at least 1% or 1.5%. So, are you basically saying without that, our GDP growth is now at 2.5%? Significantly under inflation. So I don't know how people make these predictions, but and I would not hesitate that. I think the good news is we are moving towards being that one nation, right? Towards more harmony and aligned legislation, which will ease the burden on the legislative, on the judicial system, within the country also, right? Ease disputes, make it all electronic, going forward, and simple. Legislation that's already begun to happen in so many areas, right? Yes, we're still a federated system, and that's why you have sometimes multiple layers. But you would agree an imperfect GST is better than no GST. I think everybody would.
Oh, 100%. And I think that's what the great sort of trade-off is, right? A lot of these reforms. I mean, look at the agriculture reforms, right? Everybody's been saying we need to do this. 20, 30 years, draft after draft, committee after committee. All political parties have it on their election manifestos, and then it happens. And of course, you have a large segment of the country who's now out protesting. Obviously, in response to that, they're going to have to make adjustments. But I think we'd all take some reform versus no reform, right?
Yeah, but again, we're a democracy. I think we should encourage debate. We should allow peaceful protests. When protests become not peaceful, then you have to unfortunately act. But I think that's part of a democracy. That's part of this transformation that India will see, and we should be willing to live with that. And that is why we are going to see that massive transformation. Vikas, do you want to come in? Anything you want to comment on this proposed change to labor laws? I know it's an area of expertise for you personally.
Sure. Thanks, Vishesh and Aditya. In fact, if we have to look at the labor law reforms and we have to sum up in one sentence, so that will be the big change in the mindset from the government and the bureaucracy. And why do we say that is primarily because this was one sector which was considered literally untouchable by any government in power. But the government has taken a bold step, and I'm reminded of the transition from FERA to FEMA days, and I'm sure all of you would have witnessed that, where under FERA we used to say that you can't do anything but for these few things, whereas under FEMA we transition that you can do these things but for these things. So from industry perspective, there are 2 or 3 big changes which are going to happen because of this labor law codes once they get notified and fully implemented. One is lesser compliances and the form filling exercise. Large part of the things will be consolidated into these 4 codes, and there will be digitization which will happen over a period of time. So that is one. Second is there will be more freedom for the industry to hire and fire. There are limits and thresholds like 300 employees under certain thresholds when those laws get triggered. But by and large, there is a lot of freedom being given to the industry to hire as per their will, to decide the number of hours, etc. So a lot of freedom is coming our way. And last but not the least, what is happening is earlier each state used to decide on different things. Now the bare minimum threshold or the floor price, as the word has been coined in these laws, that will be decided by the central government. States can better it, but they cannot go below that. So I think more or less the direction will be provided by the centers, and states will be guided by that depending on the requirements of each individual state. Of course, industry will also have to gear up on few points. For example, there is going to be a big change in the definition of wages. So we will have to realign in terms of the payroll structures and others, because in certain cases, the cost of running a payroll may go up, or you will have to restructure. So in the interest of time, by and large, it's a very positive move. Of course, it is very labor friendly. In order to get more labor into the formalized sector, there are certain big changes on the contract labor side as well as some part of the IT industry also gets covered. So by and large, very positive move for a sector which was earlier considered to be untouchable, and it should benefit the industry over a longer period of time, like we have seen the evolution of GST or FEMA at large. So I would stop here.
Because when do you think we'll start seeing the impacts? For example, I'm extremely impressed with the new education policy, right? But
yeah,
I think I think we're slowly coming to terms that it's going to be a while until they pass all the legislations, all the rules come out, everything starts to put in. This obviously is going to be more of a fast track. Do you have a sense?
So expected date for these 4 codes to be fully notified and implementable is April 2021. Rules should get notified up during that period. But government is likely to give about a year's time for the industry to adjust. Till that, probably the reliance could be on the older provisions, older laws as well. So we will have a transition period of about a year, and actual results of this should come in about 2 years' time. Once it gets
Are you
implemented.
seeing your clients, both Vikas and Vishesh, change their hiring plans because of this, or it's still too early to say?
I think it's too early to say at this stage, but definitely most clients are looking at the overall impact that these are going to have. And obviously, some part of restructuring is required, as I mentioned, on the compensation side, as well as in terms of the hiring, because contract labor laws are also undergoing a change. I think one more positive feature is that there's a new concept of fixed term employment coming into being, which I think the industry has always asked for, and which is a very popular concept in the Western world. So you can hire a person for a fixed duration, and all those provisions are coming into play now.
So Vikas, one more thing on the entire, labor reform agenda, and Vishesh would love to get your thoughts on this. I have consistently now been hearing that one of the side effects of COVID-19 for India is going to be a massive rush to outsourcing. Now we have SMEs in the US as well now saying, hey, we are now a lot more comfortable with doing remote work. Why can't that remote work be done in India? I think there's a lot of focus on, as you rightly put it at the very beginning, huge amount of heavy lifting in getting things to be digital. Obviously, some of those powerhouses are in India. And there was an entire thought that, okay, if there's one sector that's going to expand, it's going to be services and outsourcing, at least for the next 3 to 4 years. Lots of thoughts happening there. Do you see the labor laws really making that easier or impacting this, or do you still feel more going to be felt in the blue collar manufacturing areas?
No, I think this applies to everybody. Vikas can come in, but I think, as Vikas said, this fixed term employment is going to be a change. But if you already had fixed term employees, you will now need to start paying them gratuity. Something that earlier only applied if you employed someone beyond 5 years. Is my understanding. I think the second thing, your basic salary will need to be at least 50% of the total package. Very often, we've seen in industry, basic salary is lower, 30, 35, 40%.
But you do the variables and the deductions and all, partly for tax, but partly for efficiencies. Yes.
Yeah, the taxable incentives also, one gives. So basic goes up, again, your gratuity liability changes, right? The PF obligation changes. So both what the employee takes home as well as what the employer has to contribute to PF changes. So that's what companies are doing at this time, just reassessing their employment models, reassessing the opportunities from the code, but also some of these implications so that they have between now and next year. And that's what people like Vikas are working with, companies to help make that transition. Answering your specific question on, outsourcing, again, it's difficult to relate. I think at an overall level, all these things will be an enabler. Therefore, outsourcing, the biggest enabler will be post-pandemic, how the government's acted on the request of NASSCOM to allow work from home. Right? Before that,
absolutely, and there's a lot of stuff around safe harbor laws for captives and POEM and all, and a lot of those are still pending.
Yeah, well, it's more the Department of Telecom stuff where now you can freely operate from home instead of earlier very clearly you couldn't.
The software park problem, right? You have to be in a physical location to qualify for those incentives. Yes.
Right. So I think in the post-pandemic world, so it's really work from anywhere, not just the ability to send work overseas, but for the offshoring companies themselves to work from anywhere. So I think all those trends are extremely positive. Please go to the next slide. Right. So I think basically other few key changes, and I'll just run through these without going into any amount of detail. Again, industry ought to be aware of. The big one coming in this, the manufacturing exports for India scheme is going out. It wasn't WTO compliant and being replaced by road tax. Basically, there are various duties and taxes that are subsumed within your cost base, which even today you do not get input credit for. And effectively, therefore, the government is saying industry by industry, we'll give a new incentive which will, hopefully compensate you at least partway, if not entirely, as that MEIS benefit goes out. The challenge there for industry is, those, incentives could literally halve for our exporters, and therefore, unless there is a currency decline or a significant demand revival, it could impact exports. I think the production-linked incentive scheme initially started with electronics, mobile phones, and now has been expanded to over 10 sectors. Auto is, of course, got a significant chunk of that benefit. But I talked about this earlier in my opening comments. Really, I believe Atmanirbhar Bharat, some of these announcements is what puts the intention behind Make in India. As people were losing hope, is Make in India is only theoretical. Make in India is on paper. Ease of doing business is on paper and only restricted to these few cities. I think some of that criticism hopefully should go out as the government.
Are you seeing the PLI being taken up? There were mixed signals from those who sort of qualified and come in. They're very happy. A lot of people are feeling left out as well. Devil's in the details in the implementation. But in general, are you seeing a lot of companies being able to successfully grab these incentives?
I'd like to just bring in Vikas or Sachin Sharma, my colleague here, to take that question.
Okay, Vikas, Sachin, is this working? Because some companies, to my knowledge, are saying it's fantastic. They've applied, they've got it. It's really changed the way they're working. It's pumping up their margins. They're able to be more competitive against China. Other people are saying that, hey, we applied. There was no way we were going to qualify anyway. So this is again reserved for those, the few powers that be.
Yeah. Thanks, Vishesh, Aditya. With respect to PLI scheme, as of now, as Vishesh has mentioned, only mobile or semiconductor sector was involved for all this benefit. Now, government has included 10 more sectors, including automobile, pharma, so on and so forth. From investment perspective, PLI scheme is one of the major boost maker for all this manufacturing segment. Reason being, the subsidy which comes from all these schemes basically boost the further capitalization, further investment in that sector. It not only just linking or benefit not with respect to the refund or with respect to this scheme, but how we can create more hiring, etc., and more, or how we can make more skill-oriented laborers in India. So how to compete in China? That's all. Now, if I talk about a few sectors which has been left out, like glass and ceramics, which are vehemently discussing with the government now, why not to include that sector? Because as of now, that sector is going with the growth of 15%. As of now, 21%, 21 billion, focusing on 26 billion or 30 billion by 2028. So these kind of sectors, they are definitely which are left out, discussing with the government to be included. But yes, it is a very welcome step from government of India, and that's how many companies, as Vishesh has mentioned, Samsung and Apple is also focusing on. They are increasing their capacity because of all these schemes.
Yeah. Yeah, definitely. So, thanks, Sachin. Yes, I think in summary, we're working with the glass and ceramics sector. He just gave you an example to talk about how that's a sector could also be one of the priority sectors for the future. So, whoever's not currently included, the government is keen to look at any sector that needs that support, that can compete for these relocating supply chains, can produce jobs in the country. And the door is very much open. Your question around, have we started seeing, investment? Of course we have, but people are still, also making plans. So in the mobile phone sector, which was announced, perhaps maybe 3 or 4 months ago, we've seen the maximum, early interest. But the others, auto comp is, definitely also following quickly behind. I think that's, the other significant gainer from this. But the government is actively engaging, and I talked about at least one sector where we are directly engaging, with the government, a pretty wide sector, glass and ceramics, along with CII actually. So I think the last thing I touch on in the interest of time is going to be the other announcement, which was also part of Atmanirbhar Bharat. Surprised us and surprised a few other people, but something that was already in discussions. Back in 2005, the laws were changed, which basically made the ability to directly list overseas for an Indian company not possible. So you had to first list in India before you accessed overseas capital markets. And why I'm saying that is we've ourselves seen before that and around that the interest from small and mid-sized companies. We listed a 60 crore guarding company in London in 2007-8. That company is now in excess of 1,500 crores, right? And we've seen the potential for those markets to truly open up the capital base for mid-sized companies, for thereafter, to broaden the investor base, for thereafter open up the brand visibility, and also for that to be available as a currency to make acquisitions. That company has since acquired businesses in Vietnam, Singapore, and London.
Right? This is I think a fantastic example. How many companies do you think will actually take over this? So I've been asking this question, by the way, to almost everybody who I run into who's involved with taking companies public.
So I can tell you, so about 50 to 60 Indian companies listed overseas in that period since we saw some sort of spike of overseas listings of Indian companies. If direct listings were permitted, I would have expected that number to be close to 300, right? So I feel we would see at least 200 listings of Indian companies on overseas exchanges between now and the end of this decade. At least 200, compared to
That's
50.
a huge number. And as you rightly said, it's not just about the money, it's about the branding. You have 200 companies that are in whatever Robinhood portfolio of some investor in the US, that fundamentally changes how people see India.
Yeah, I mean, absolutely. There's 250 Chinese companies that access US markets despite, their challenges, and they're facing huge, pushback, or because of the, how poor their standards are, how poor their compliances are compared to ours. We are, amongst the best in the world in terms of transparency, at least, the standards we adopt in governance and otherwise. So I feel we will not only, get to the number China has in terms of raising capital in the US and other markets, but actually, go way beyond that. because of the reasons that are again on the slide. It's a much broader investor base than the investor base you can access in India. And if you look at certainly some sectors, renewables, early stage companies, loss-making companies, small companies, 50 crores to 500 crore companies which have huge growth potential in front of them. The ability to raise capital in India is still very limited, public capital. Right?
And I just want to explain to our audience why, one of the big challenges that happen is because India, although they've softened the requirements, but requires about 3 years of profitability. So a lot of our very glamorous, famous NGOs like Amazon, Flipkarts of the world, who have never turned a profit, can actually use this. I mean, okay, those two are bad examples, but companies of that size and scale as well, they're not allowed to list in India because they haven't turned a 3-year profit.
Absolutely. At least on the main boards, I'm parking aside our attempts at smaller boards. I think the good thing here is the change in thinking. I think the thinking back in 2005 was, if we allow Indian companies to list overseas, we will take away listing opportunity from our exchanges, our control over those companies. What people did was effectively set up a holding company overseas and sell the shares of the Indian company to that holding company. Effectively, they ended up flipping their structure. And effectively, you ended up helping Indian companies and Indian owners to become non-residents and overseas held companies. I think it's refreshing to see the change, that we now have the confidence that you can't list on any market you want unless you have a great story, right? There are certain markets which are more appropriate for renewables, for early stage companies, for commodity companies than the Indian stock markets. And therefore, and eventually it's about creating jobs. It's about helping those companies grow. Why not help that capital?
And one thing which and I think it's about out of time, but one of the things that Vishesh and I didn't cover, of course, is the dramatic hit on public finances that have happened in the past years. I mean, some of our states, Delhi, for example, is effectively bankrupt. The entire collections are down. The tax base is getting eroded. Unless the government finds a massive wall of capital and then ways to bring more and more investment in, for a lot of social services, it's an existential crisis.
Absolutely, that's the matter of another debate, on our state of public finances. Of course, with the pandemic having caused challenges that weren't foreseen earlier, even when we adopted the GST, and of course that's what we're seeing the government now address through this borrowing mechanism that they put in place. But let's not. We'll have to find another opportunity to discuss that. I think.
Last big question, right? Two big reforms that you sort of see are game changers, right? One, I think this entire thing around labor codes, assuming the implementation is imperfect, just like GST, still a massive, massive reform. The second we've talked about is this entire direct overseas listing, huge opportunities for startups, for companies who are in there to really get those big valuations and find exits into a larger pools of capital. And I think a 200 number, 300 number, I completely agree with you, is not just reasonable, it's probably conservative. Third big reform that you think that will really bring positivity for next year?
Very difficult, Aditya, to pick one out. I talked about everything, IBC, RERA, GST, Companies Act simplification. I talked about the corporate tax rate simplification, reduction in the country, the new education policy. Sorry, I'm suffering from this terrible virus. Hopefully it's not. It isn't COVID. I'm pretty sure it's not COVID. The new education policy. You touched on it yourself.
Do you think the government is done with reforms, or still we can expect?
I just think if I was to pick one out, it is going to be the end of government monopoly and opening everything up to the private sector, which will kickstart the process of actually hasten the process of privatization in our country, because the intent becomes clear. I think that would be the one reform I would say. We probably, in the entire Atmanirbhar Bharat announcements, everything else, we probably did not appreciate the government for enough. That is a huge step.
And the way I love how Vishesh put this, it's not just about the announcements, right? It's about the intent. It's how the thinking has changed. What are the conversations you're having? Are we discussing still pre-1991 type socialistic nanny state laws, or now are we just nitpicking on how great the reform is, right? And I think the government, particularly in the last 4 to 5 months, and this is the same guys who did demonetization. I mean, if they have the guts to do that, everything is on the table. And I think they've shown that. I think stuff like the labor code reforms, agriculture reforms, NEPs, these are political third rail hot wires that very few governments are willing to touch. And here we have huge proposals being pushed out and being put into law very soon. So I think that gives a lot of credit and a lot of positivity to what will happen in 2021, especially after we've seen all those very sad-looking numbers for the past 2 years.
I think those numbers have to be dealt with. Those numbers will be dealt with. You will see, numbers, but don't expect to see them before March 2022. Don't get disheartened looking at short-term data. I think post-pandemic we should not look at short-term data. If you want to look at data, look at high-frequency data. Look at PMI, look at vehicle registrations. Don't look at GDP. Don't look at that data. I think you also mentioned that, Aditya. I would, I think there is every reason to be optimistic. Yes, if there is one reform that the government ought to also focus on and deliver, that isn't, really to the fore as much as I would like to see it currently, it would be that, reform of our legal system.
No, absolutely. The fact that our rank is so low in settling contracts, it's unsettling.
Just again, look at the positive of that. I'm an optimist at heart. Just imagine if we could fix that. What's the sort of FDI we could get into the country? What's the sort of foreign investment we would get? Because I speak to investors, and that's the one thing they say.
Oh yeah, I know. As an Indian company, I would double or triple our investments, right? Because when you can trust a contract, guess what? You sign a lot more of those, right? Because you trust that performance is going to happen, and you don't waste time. 3 to 4 months. Just will this work? Will this not work? The risk appetite changes.
It's the ability to take anyone to court if you feel you've been wronged, right? Whether that's an investor, whether that's a business partner, even whether that's a regulator or government, right? So I think if we can, give people that certainty.
That there is legal recourse, right? That the paper they sign, the contract they sign will be enforced, right? And
within a period, within a time period that's reasonable.
Within the time period, right? I think that's the big one. In India, contracts do get enforced, but sometimes that's 5 to 10 years, right?
Absolutely. So I think a lot to be optimistic. It is going to be a vertical climb for our economy. Fasten your seatbelts. Not everything that you see in reform will make everyone happy, but that is the cost of seeing this transformation.
Absolutely, so and I think you and I both agree on this, right? We'd rather have 20, 30 blockbuster reforms done reasonably well within a short period of time, rather than, achingly wait 5 years for one good reform, right? It's better to just get them out and then we'll fix them as things go on.
Version 1.0 is always, my approach. Let's not try and, perfect everything.
Perfect. Thank you so much. I every time we do this, I always feel that we need to get at least 2 to 3 hours and we need to structure it bit by bit. We still have 20, 30 questions, but I know we said that we'll try to wrap it up in an hour and a half. Thank you so much for coming in. I love the numbers. I think this is exactly what we all needed to hear. Thank you so much for the audience. I saw many of you have sort of stuck us through here, particularly on LinkedIn and YouTube. Our apologies for not getting to the I think the last 20, 30 questions we had there. But I think we managed to cover most of the questions that sort of were coming up through Vishesh's presentation. And as we went through slide by slide, I look forward to maybe doing this in April and then seeing, what's happened after that.
Absolutely. We'll be delighted to. Hopefully I'll feel better and not this My apologies, for today for my throat and if my voice wasn't absolutely clear at all times.
Vishesh, you were perfectly clear. Thank you so much, as always. Great to have had you with us. And thank you, everybody. Please have a great evening and a fantastic weekend.
Thank you very much. Thank you, Vikas and Sachin, and everyone who attended.